Hey, what's up, everybody? Welcome back. My name is Scott Newhouse, Certified Financial Planner. Thank you for being here. Shout out to the dozens and dozens of people all across the world tuning in. So I was in a client meeting a couple weeks ago, and they asked me which account, if we needed to, should we tap for long-term care expenses. And so I've been thinking about that. If you've paid any attention to long-term care, you know how expensive it is now. Average nursing home could cost around $110,000 annually, and that's a nationwide kind of survey. So if you're in California, New York, New Jersey, Connecticut, it might be much higher than that. Home health care aides can cost you anywhere from $50,000 to $70,000 to maybe even $80,000 a year. And the average person does need long-term care. It ranges between male and female, but the average person does need some kind of long-term care help for 2 to 3 years. And now, that help that you need, it might be, more minimal. It might not be $110,000 worth of help per year, but people need help for multiple years towards the end of their life when it comes to long-term care. Around 7.5 million people have long-term care insurance, which means most of us do not have long-term care insurance. And so if you're going to self-insure, that's basically what we call it. If you're going to pay for long-term care expenses yourself, you're basically, I don't want to say gambling, but you're assuming the risk. You're saying, I don't need that health insurance, I don't need that insurance company to split the cost with me, so I am going to cover 100% of those costs myself. And so that's where the question for my client came into play. Where do we take money from our accounts when we need to, if we need to, for this long-term care? And so I've been thinking about it, and the first thing that I want to say on this is that you don't necessarily want to take it from the account that's going to have the lowest tax impact or create the lowest taxable event. And the reason why is because there are certain tax advantages for actually incurring taxable income and claiming those expenses. And so let me kind of explain what I mean by that. And so the reason why you don't necessarily want to take it from the account that's going to have the lowest tax consequences is because of something called the medical expense deduction threshold. This is an IRS rule that says if you have healthcare costs that exceed 7.5% of your AGI, which is your adjusted gross income, then all of those healthcare expenses above 7.5% are deductible on your taxes when you itemize. And so probably around 90% of people take the standard deduction on their taxes. But if you have a lot of long-term care expenses, i.e. healthcare expenses, then most likely you're going to be itemizing your taxes instead of taking that standard deduction. And so that's where this kind of all comes into play. Let's say, for instance, your AGI is $60,000. That means you need $4,500 of medical expenses to start claiming those deductions. So if $60,000 is your AGI, and then you have $3,000 of medical expenses, well, then guess what? You can't deduct anything. But in the same scenario, $60,000 AGI, and then you have $10,000 of healthcare expenses, then guess what? You can start deducting $5,500 of those expenses on your tax returns, which will lower your taxable income in that current year. And so we need to keep that in mind when we're thinking about what account should we pay for long-term care from. So let's go jump into the first account that I think we should take from for long-term care expenses, and that's our traditional IRA/traditional 401k, i.e. your pre-tax accounts. Now, this might surprise some people because, as you know, as you savvy viewers know, when you take money out from those pre-tax accounts, it counts as ordinary income. But here's why it's a good idea. If you have a lot of long-term care expenses to take it from, or to at least think about taking it from these accounts. Let's say you've got $50,000 of Social Security income and you withdraw $90,000 from your IRA or 401k pre-tax for nursing home care. Well, now your AGI is $140,000, right? So 7.5% of that is $10,500, which means any expense above $10,500 is deductible on your taxes, which means of the $90,000 of long-term care costs that you're going to have in that year, $79,500 will be deductible as an itemized deduction on your taxes, which can not dollar for dollar offset your tax income, but it can help deduct a heavy portion of those long-term care expenses. Plus, as you know, after age 73, you're going to have to start taking required minimum distributions from these types of accounts, and so using them for long-term care, it It just helps kind of lower the burden that you're going to have to take for the RMDs. And then also when you pass away and you give them to your, let's say your kids, well, they're going to have to pay taxes on those distributions anyways, and they're going to have to, withdraw the whole account within 10 years. So basically, we're already going to have to pay taxes. Someone's going to have to pay taxes on this account anyways, either you or your beneficiaries. You're going to have to take distributions from this account from your RMD. So all of that leads me to say, hey, if we've got, a big chunk of money that we need for long-term care, and you have options in terms of taxable, pre-tax, after-tax accounts, we really should look at pre-tax accounts so we can maximize that medical deduction and get as much of a benefit tax-wise from taking it from there first. The second place I would encourage you to think about taking money from is your taxable accounts. So your taxable accounts do have a lot of flexibility for long-term care funding, because let's say you bought some funds at $50,000 and then they grow to $90,000 and then you sell the whole thing for healthcare expenses. That $40,000 worth of gain is going to be included on your adjusted gross income, which means you can still claim some of the medical deduction for your long-term care expenses. It's not going to increase your income as much as it would from the pre-tax accounts, which means you are not going to be able to deduct as much. So, because if you have less income, then you have less potential deductions, right? I mean, that's just basic math. So you're still going to get some benefit from taking money from the taxable accounts, but not nearly as much as from the pre-tax accounts. Also, there's no age restrictions or required distributions, which means that you have complete control over the timing when you take it from these taxable accounts. And if you don't need the money from the taxable accounts, then you just leave it in there. And then your kids, I'm assuming they're your beneficiaries, they're going to get that step up in basis, which is going to be really nice for them tax-wise when you're gone. And then the third place that I'm going to say to take money from your accounts for long-term care is actually your Roth IRA, Roth 401k, in any kind of after-tax accounts. And that might sound counterintuitive to a lot of you because we think about, taking money from a Roth, there's no taxable income as long as you follow all the rules. And it's just really nice to get money from that tax advantage accounts and not have to pay anything on your tax return since you've already taken care of it years prior. But the reason why, and I'll just pull up a little chart on the screen and I'll share it with you guys right now. But let's just go through the reason why. Again, we're starting with $50,000 of Social Security income, and we need $90,000 for long-term care. And you see on the left with the Roth IRA withdrawal, that's all tax-free income. So your AGI doesn't increase, which means the amount that you're going to be able to deduct doesn't increase either. So if you're at 50,000 AGI, just Social Security income, you can only deduct expenses above 3,750, which still means you can deduct a big portion of your long-term care cost, but a lot of it is unused because your income's not high enough to deduct the full amount. And so let me just break this down into numbers. And again, it's on the chart, but let me just read it out for you here. So we've got 90,000 withdrawal from the Roth IRA, 50,000 of Social Security income, but your adjusted gross income is still only $50,000. Medical expenses still at $90,000, which means with the Roth IRA scenario, you can deduct on your itemized taxes $42,500, but the unused deductible amount is $43,750 that you cannot claim on your taxes because your AGI is not high enough. Your AGI has to be you can't claim deductions above your AGI is what I'm trying to say. But again, going back to that traditional IRA withdrawal example, we'll have $90,000 of medical expenses. You'll be able to deduct $79,500 expenses, and then the unused deductible amount is that $10,500 because that's the floor of the medical expense threshold, the original 7.5%, above 7.5%. So since that $10,500 is below that, we cannot use that. And so if we are at a 22% tax rate on federal taxes, you'd be able to save around $17,490 on the tax IRA withdrawal, whereas on the Roth IRA, you'd only be saving around $9,350. So still pretty good that we're going to get some deduction there on the withdrawal with the Roth IRA, but it's a little bit more than just half of what you could do with the traditional IRA withdrawal. Okay, so the last thing before we wrap up is HSAs. So HSAs are also after tax, but it's the same thing with the Roth IRAs. When you take money out from that account, it's not going to increase your it's not going to increase your AGI because there's no taxable income when you follow all the rules taking money out of the HSA. So I just don't see a reason to take it from that account if you've got a big medical bill coming from long-term care. Now, if you have a lighter, smaller long-term care needs, then maybe an HSA is a good place. But if you have really heavy costs from long-term care, I really think the best place to look is your tax-deferred traditional IRA, traditional 401k. After that, I'd go to the taxable accounts, and if you have lighter expenses, I'd look at the HSAs as well as the Roth IRA if you're not trying to increase your tax burden. So I know it's a little convoluted. Put any questions or comments down below in the comment section below. And the last thing I'm going to say before we end here is that tax diversification is essential. If you have all of your money in one account, well then guess what? This entire conversation is moot. But if you're in your 40s or 50s or even early 60s, and then we can put together a plan to diversify your account so that you have these options in retirement or over your 60s, 70s, 80s, and 90s. And then you can use different strategies depending on what the tax rules are at that time. Then you're just going to have more options at your disposal, and you're going to have the potential for the potential for lower tax rates and lower lifetime taxable income. As we saw on the chart that I shared, there's just different tax consequences with different accounts, and that's why we want to have some tax diversification when it comes to our accounts. So I hope this is helpful. I hope you guys enjoyed it, and I will see you next time. Bye.